It's a bad year to need money. The market just fell. Headlines are red, prices are unstable. One person depends on his investments to pay his living expenses, so he withdraws money right in the middle of the crash. Another person faces the same crash, same market, same returns, but he doesn't need money yet. He keeps his investments untouched. Years pass, the market recovers, numbers go up again, but only one of them is fine. No one made a mistake. No one chased risky returns. No one panicked. The only difference was when the market fell relative to when they needed the money. This hidden problem has a name. It's called sequence of returns risk. And it explains why two people can earn similar returns and still end up in completely different places. Because when you're taking money out, losses at the wrong time don't just hurt, they permanently change the future. This isn't really a return problem, it's an order problem. Markets go up and down for everyone. Gains and losses happen to all investors. But when losses happen at the same time you need money, the damage is much deeper. Think of two portfolios. Both rise and fall over time. Both experience good years and bad years. The difference is simple. One portfolio is being withdrawn from, the other is being left alone. When markets fall, the person withdrawing money is forced to sell at low prices. The other person does nothing and waits. That single difference quietly changes the future. Now bring this into real life. The cost of living keeps rising. Rent goes up. Groceries become more expensive. Bills don't wait. If your income is fixed or slow to adjust, you start relying on savings to cover everyday expenses. If the market is down at the same time, pressure comes from both sides: investment losses, higher living costs. This is why a sequence of returns risk is small during your working years, but dangerous when you're taking money out. At that stage, average returns don't protect you. And when inflation is added on top of this, the risk becomes even more serious. Because now you're not just fighting market losses, you're fighting rising prices at the same time. Most people hear this and think it's a market problem. They say, markets are risky, stocks are dangerous. Timing the market is impossible. But that's not what this is about. Sequence of returns risk isn't about predicting crashes. It's about understanding what happens when life and markets overlap. Because markets don't care when you retire, when you lose a job, when expenses increase. Life events don't wait for good market conditions. This is the mistake many people make without realizing it. They plan based on average returns, long-term charts, it always recovers stories, but they don't plan for when the money needs to leave the system. Money going in and money coming out are two completely different games. The rules change the moment withdrawals begin. This is why two people with similar portfolios can feel completely different levels of stress. One feels pressure, the other feels time. Not because one is smarter, but because their timing puts them in different positions. This doesn't mean investing is bad, and it doesn't mean you should stop investing. It means you need to separate growth money from survival money. Before withdrawals, volatility is noise. After withdrawals, volatility becomes damage. The same market behavior creates completely different outcomes depending on one thing. Are you adding money or removing it? One simple protection is time. Keeping 1 to 3 years of expenses outside the market means you're not forced to sell during bad years. Cash isn't there to grow. Cash is there to protect your future returns. The most powerful strategy isn't higher returns, it's flexibility, the ability to wait. And this is where most people take the most expensive risk of their lives without realizing it. They think, I'm investing, but what they're really doing is making a silent bet that life will never ask for money at the wrong time. That bet usually goes unnoticed during good years, Markets rise, portfolios grow, everything feels fine. Until it isn't. Because markets can recover, time can heal prices, but forced selling steals something that never comes back: future opportunity. This is why planning only for returns is incomplete. Returns tell you how much you might earn. They don't tell you whether you'll survive long enough to benefit from them. Before withdrawals, volatility is just movement, numbers going up and down, noise on a chart. After withdrawals, volatility becomes permanent damage. Every dollar sold at a low price is a dollar that can't participate in the recovery. And this is where the real divide appears, not between smart investors and foolish ones, not between people who time the market and those who don't, but between people who have time and people who don't. Time is the most underappreciated asset in investing. It doesn't show up on statements, it can't be bought at the bottom, but it quietly determines who wins and who struggles. This is why flexibility matters more than brilliance. The ability to wait, to delay withdrawals, to slow spending during bad years, to give your investments room to breathe. A few years of expenses kept outside the market isn't a drag on performance. It's insurance against being forced to make irreversible decisions at the worst possible moment. Cash isn't there to grow. Cash is there to protect your future growth. And this is the part most long-term charts don't show. They don't show job losses, health problems, family emergencies, rising rents, higher food prices. They assume money stays invested. They assume withdrawals happen smoothly. They assume life cooperates. Life doesn't. Markets move on their own schedule. Life moves on its own timeline. Sequence of returns risk is what happens when those two timelines collide. That's why two people with similar portfolios and similar returns can end up with very different lives. One feels constant pressure. The other feels patience. Not because one was smarter, but because one had room to wait. This isn't about fear, and it isn't about avoiding risk. It's about understanding that the goal of investing isn't to maximize returns at all costs. The real goal is to stay in the game long enough for those returns to matter. Because wealth is rarely destroyed by bad markets alone. It's destroyed when bad markets meet bad timing. If you enjoyed this video, please like it to support us. Watching on YouTube, subscribe to the channel. Watching on Facebook, follow our page so you never miss our upcoming videos. Until next time, take care.